Good evening, everyone. I have to correct that introduction. I'm not president, I'm past president. You'll meet the president in a minute, who's going to introduce the speaker for tonight. My role, though, is to present the prize to the winner of this year's Royal Economic Society Young Economist of the Year essay competition, which I guess many of you will be familiar with. There were more than 2,100 entries this year, and the overall standard was extremely high. The judges, that's myself, Stephanie Flanders, now JP Morgan, but many of you will know her as the BBC's economics correspondent, and Professor Jonathan Haskell of Imperial College London, agreed that the best essay was by Louis Cheng from Westminster School, who addressed the question, does the economic case favour a new airport runway at Heathrow, Gatwick or elsewhere? Well, the judges thought this essay on the relative merits of Heathrow and Gatwick as the site for additional runway capacity in the UK was well organised and elegantly written. And the author clearly brought out the distinction between private and social costs and the benefits of different options, arguing that the cost-benefit calculus, the social cost-benefit calculus, favoured choosing Gatwick, so he disagreed with Howard Davies. The judges were particularly impressed by the use of original international evidence to make the case that distributing passengers across multiple airports constituted a viable business model rather than just concentrating them all through a single super hub, which is often what people believe to be the only model. Anyway, the judges unanimously agreed that this would be a worthy winner of the 2015 Young Economist competition, so I'd like to invite Louis Cheng, please, to step forward to collect the trophy, which is a very nice sort of glass. And with that, I'm going to hand over to the current president of the Royal Economic Society, Professor John Moore, who will introduce tonight's speaker.
Good afternoon, everyone. Welcome to the Royal Economic Society's 2015 public lecture. And welcome to those of you who have come here today to the Royal Institution here in London, and welcome to those of you who are watching the lecture online. Demand for places today greatly exceeded supply, so the market did not clear, and evidently we should have raised the price above zero. I'm sure that the excess demand for places stems from the eminence of today's speaker, Professor Rachel Griffith, and the provocative title of her lecture. Now, this is an auspicious year for the Royal Economic Society. It's our 125th anniversary. We are the oldest such learned society in the world, and many famous economists have been involved with running the society, notably John Maynard Keynes, who was the Secretary General for no less than 32 years. And it's my great honor to be president this year, and one of the pleasures of being president is to select the speaker for this annual lecture. Well, I have to say that my choice took me no time at all. In my view, Professor Griffith, where is she, stands out as one of the most foremost economists of our time. Now, that's quite a bold claim, isn't it? Let me explain. Professor Griffith works at the crucial interface between economic theory and empirical research. These days, it's no longer enough for an economist to build theoretical castles in the air. The name of the game is to understand the world by getting your hands dirty with data, lots of lovely microeconomic data tracking the behavior of individual firms and households. And modern computing power enables us to grapple with these big data sets. But you need a formidable set of skills to make a success of your analysis. You have to be seriously well-trained in statistics, what we call econometrics. You also have to have tons of energy and common sense and, above all, cleverness. You have to have good judgment, have a nose for a good problem, and crucially, you have to use economic theory. It's economic theory that gives you a framework. It's economic theory that gives you a perspective for corralling these enormous data sets. It's economic theory that gives you strategies for finding testable hypotheses. And it's economic theory that helps you to identify whether you're estimating the demand curve or the supply curve. Now, I say all these things as if I knew from personal experience what I'm talking about, but I don't. I'm afraid I'm one of those pure theorists who builds castles in the air. The future belongs to the likes of Professor Griffith. I look at her with admiration and actually awe for not only the formidable range of skills that she brings, econometrics, economic theory, excellent taste and judgment, energy, common sense and cleverness, but the fact that she's got all these things in abundance. Believe me, people like her are extremely rare. And it's because of that that I say that she stands out as one of the foremost economists of our time. Now, clearly, I'm not alone in thinking this about Professor Griffith. The Queen thinks so as well, because she appointed her a commander of the British Empire recently. And Professor Griffith's reputation spreads across the world. For example, she was recently elected at a ridiculously young age to be president of the European Economic Association. And among her many other roles, she is to become the research director of the Institute of Fiscal Studies. And in my view, the IFS provides easily the most serious economic commentary on UK economics. Professor Griffiths has recently taken up a professorship at the University of Manchester, but she could have taken a top professorship anywhere in the world, at any of the very top US universities, if she had chosen to move there. And it's our great fortune that she chose to work in the UK. And it's also our great fortune that she has kindly agreed to give today's lecture. So may I present to you Professor Griffith.
Well, thank you very much. I'm slightly blushing after all that. Okay, so what I'm going to talk about today is start out by talking about, does Starbucks pay enough tax? So you might not be surprised to hear that the answer to that is not going to be yes, and it's not going to be no. The answer is going to be honest, I have no idea. But I think one of the things that John said is complimented me on my cleverness, and I think one of the things about being clever is understanding when you don't know the answer to a question, as well as when you do know the answer to the question. And so what I want to talk about today is how we can use economic intuition and some facts about the world to try and better understand what that question means and how we might be able to answer it. But I'm smart enough to know that I don't actually know the answer. So I think that's, don't be surprised if that's where we end up. Okay, so why is this an interesting question right now? Unless you sort of had been living in a cave or had your head buried in the sand, you will have seen in the newspaper over the last few years that there's been a lot of controversy about the amount of tax that some high-profile large multinationals pay, or rather don't pay. So in 2012, Starbucks became the target for a bunch of public protests here in the UK. Here's some pictures of those protests. They're Arbucks, not Starbucks. It's a particularly catchy one. And so the issue was around the fact that Starbucks had paid very little corporate income tax. So what I'm going to be talking about today is corporate income tax, and I'll come back to explain exactly what that is in a minute. But so Starbucks had paid very little corporate income tax since it entered the UK market. In fact, they paid none. They declared zero profits, despite the fact that you can see a Starbucks on every street corner, and we all know that they're very expensive, and so they must be earning some profits out of that, surely. Okay, so that was upsetting people. More recently, there's been controversy over Facebook's tax affairs and the very catchy headline that One Direction, 4 young boys who sing for a living, had paid 8.2 million in UK corporate income tax, while Facebook had paid something like £4,000. Okay? And so I'm going to come back to those two examples in the end to talk about, is that sort of fair that they paid that little tax, and why has that arisen, and how might we think about what issues arise because of that. So this concern's not just been in the headlines in the media. It has been widely reported in many different forms of media in both the UK and the US. But it's also been government officials. So David Cameron said in a conference in 2013, referring to the Starbucks controversy, companies need to wake up and smell the coffee. And that was widely quoted. More recently, John MacDonald, who is the shadow chancellor for the Labour Party, said, we will force people like Starbucks, Vodafone, Amazon, and Google, and all the others to pay their fair share of tax. So one of the things I want to come back to is that particular word in that sentence, people. So Starbucks, Vodafone, and Amazon are not people, they're companies. And I'll talk a bit about that as we go along, and I think that's one thing that's very important to remember when we're talking about corporate income tax, that they are not people. They are groups of people that form a company. So this has also been an issue that's been of much concern in big international organizations like the OECD and the EU, who have been trying, with very little success for something like the past 20 years, to reach some new consensus and agreement on the way that we should tax multinational firms. And one of the things I want to come back to is the kind of role of governments in this. That, in fact, it's the inability of governments to reach a consensus decision on this that's one of the problems that we face. Okay, so before I turn to some of those questions, I think there's one interesting fact that it's useful to keep in mind. So when people talk, if you read those headlines, if that was the only source of information that you had, you would think that we were basically collecting very little tax revenue from companies. So one could easily think, based on what you'd read in the paper, that there'd been a big decline in how much corporate income tax companies were paying. But in fact, when we look at the data, that's not what we see. And John complimented the Institute for Fiscal Studies for its analysis, and I think this is, one of the fundamental things that we do at IFS is just very carefully understand some basic facts. These are not special hidden numbers, these are published by the government, but I think are not widely perceived by the populace. So what I'm showing here on this picture is we have from 1980 to nearly the current day along the x-axis, and the y-axis is the percentage of total tax revenue, so of all of the tax revenue that the government collects, what percentage of that comes from corporate income taxes, okay? And so one thing you see is that it goes up and down a lot. It goes up and down more than other taxes because during recessions, company profits fall off. So they're a bit more cyclical than many other forms of tax. But what's noticeable about that line, to me, is that it's not obviously trending downwards. So if we look over the last 30 years, it about averages 7%. And there, recently you might say it's going down a bit, but it's pretty stable. And that's despite the fact that at the beginning of this period, corporate income was taxed at 52%, whereas at the end of the period, it was taxed at 20%. That's a dramatic reduction in the tax rate, yet we're still collecting pretty much the same amount of revenue from corporates. That's because the size of the corporate sector has grown. Both more of the economy is now in corporations than not in corporations, and two, the corporate sector has become more profitable than it used to be. Okay, so what I want to talk about specifically is, is that a fair share of tax? Should they be paying 7%? Or is that not a fair share? Should they be paying more? What do we even mean by a fair share? So when we start talking about corporate income tax, as I highlighted, one of the things we really need to think about is who's actually paying for it, and paying for it in an economic sense meaning who's made worse off by the fact that the tax was imposed on them. Corporations are not people, so they can't be made worse off, so we need to think about who's actually paying for the tax. And then I want to spend most of the talk thinking about, so why has there been this recent increasing concern over corporate income taxes? If you'd read the papers 25 years ago, when John complimented on being young, but I'm not that young, I was a working economist 25 years ago, and all of the concern then was that we were taxing multinationals too much, that they were paying too much tax because they were paying tax in multiple countries. And now suddenly the debate has turned to companies are paying too little tax, yet the data suggests that they're paying about the same amount of tax. So what is it that's changed? Well, one of the things that's changed is there's maybe more variation. Some companies are paying a lot, some companies are paying not very much. And I want to talk a little bit about some of the reasons behind that, and some of those are to do with something called intangible assets, which I'll talk to you about, and about the greater mobility of firms across international borders. And then I'll end by trying to think a little bit about how much tax we think firms should pay. I don't have the answer to that, but I maybe will convince you by then that we can at least ask the question more intelligently and talk a little bit about where they think they should pay it. And I think where is as important as how much, and in fact, a lot of the recent controversy is more about where they should pay it than about how much they pay. So the first thing I want to emphasize is that when we talk about a fair share of tax, one thing we need to be very careful about, and as economists, we don't really think about thinking of a single tax in isolation. We have a complex set of taxes and benefits. So the government collects tax revenues, and then it gives some of that money back to people in some forms of insurance or benefits if you need to go to the hospital or various things. And we generally want to think about the whole tax system and how fair it is. You may pay one kind of tax, I may pay a different type of tax, but if we both say pay the same amount of tax, are we really worried about that? It may be more effective or more efficient for the government to raise tax from you in one way and tax from me in a different way, and we may not worry about that if in the end we're paying the same amount. So in general, we don't think that we need to equalize, we don't need to have, each tax doesn't need to be fair in itself. We think of fairness as a property of the tax and benefit system as a whole. Okay, and so thinking of corporate tax in isolation may not make that much sense. And when we try and look at the, so one of the things that IFS tries to do regularly is look at the fairness of the entire tax and benefit system. So we can do a reasonable job at doing that if we look at most taxes, like labor taxes and VAT type taxes. It's really hard to do that with business taxes, and I'll tell you more in a minute. So what I have here about why that's the case. So what I have a picture here is what's called the distributional impact of the UK tax and benefit system, not including corporate income tax. Okay, so for the rest of the talk, I'll say what we can say about corporate income tax and why it's difficult to include it in this picture. But what this picture shows along the x-axis, we have on the left-hand side, we've divided the population of the UK into 10 groups based on their income. So on the left-hand side, we have the poorest 10% of the population, and on the right-hand side, we have the richest 10% of the population. And then the y-axis shows us the percentage of their income that is taken away or given to them by the tax and benefit system. So a line that goes below zero means that they pay net taxes. They lose out in aggregate from the tax and benefit system. And a line above zero means that they receive more money than they pay. And so what you see is that overall, we have a very progressive tax system. People in the poorest part of the income distribution receive something like 50% of their income from the state in redistribution, whereas people in the richest part of the income distribution pay something approximately 50% of their income to the state. Okay? So that's generally what most economists would think about, thinking about how fair do we think a tax system is what would our social preferences be over the slope of that line? How much should we be redistributing from rich people to poor people? And we normally think that there should be some amount of redistribution, and we may have different views on how much, but that's how we can talk about fairness in the tax system. So not about an individual tax, but a group of taxes and benefits taken together. So one point is fairness is not a property of the tax system. Secondly, if we do want to then go on to think about fairness of the entire tax system, we then need to be a bit more clear about what we mean by fair. Does fair mean relative, I want you to pay us the same amount as me relative to my income? Or does it mean something more like, if we're thinking about firms, if firms are utilizing some resource that the government provides for them for free, like roads or something, do we think it's unfair that they're not paying some share of that? So there may be other concepts of fairness rather than just across the income distribution, but about whether you're paying for the things that you consume, or about whether one company is paying the same amount as another company. So if Starbucks is paying no tax, is Cafe Nero also paying no tax? And if that's not the case, is there some inherent unfairness in that? And so we need to be a bit careful in thinking about when we use the word fair, what we mean by that. So as I said, when I looked at this picture, so this looks at the entire tax and benefit system, not including business taxes. Business taxes are basically corporate income taxes and the taxes that firms pay on their properties, business rates. I'm not going to talk about business rates. That's a very arcane topic. You might think corporate income tax is arcane enough, but business rates, I won't go there. So when we talk about something like corporate income taxes, as I highlighted in that quote in the beginning by John McDonald, saying that people like Amazon and Starbucks don't pay a fair share of tax. Well, companies are not people. So when we talk about the burden of a tax system, there's one thing that people often think about is like legally who pays the tax. So who writes the check to the Inland Revenue? Well, in fact, companies write almost all the checks to the Inland Revenue. For labor taxes, we have a PAYE system, so the firm writes the check. So most of the checks that get sent to the Inland Revenue, we don't send checks anymore, but backs payments, get sent by firms. But that's not what we're interested in. What we're interested in is what we call economic incidence. So who is made worse off because of the tax? And firms can't bear the economic incidence because they can't be made worse off. They're not people. So we need to think about who are the people involved in the firm and which of them is made worse off by the imposition of the tax. And economic incidence can be very different from legal incidence. And so I'll talk a bit about that. So I'm going to talk a bit about that in the context of a lemonade stand. As Ramesh said, this is very peanuts of me. But so this is the basics of corporate income tax, and then I want to use it to illustrate what I mean by incidence. So imagine that you're a young American child of 5 years old or something, and you want to open a lemonade stand. And so your mother gives you $10 to open the lemonade stand, and you invest that $10 into buying lemons, sugar, a pitcher, some cups, and you pay yourself some wages. That's a simple typification of what a firm does. The mother is the shareholder invests in the firm uses that money to buy materials and invest in capital equipment and then pays wages. Okay, so then you sell the lemonade, you sell 50 cups at 25 cents. That means you have a total income of $12.50. Your costs were $10 that your mother gave you, you need to pay back. You have profits of £2.50. So in a normal company, that would go as a dividend back to your mum. Your mum would be the shareholder, she'd get a £2.50 dividend, okay? So now what happens if we introduce a tax? So say the government introduces a corporate income tax at 40%. That means that we have to pay 40% of the profits back to the government. So we have to pay the government $1. We had $2.50 to $2.50 of profit, and we need to pay $1 of that back to the government. That's the basics of how the corporate income tax system works. Obviously, there's a few more complications when we talk about large multinational firms, but that's the basic idea. So the question of incidence is who's going to pay that? Who's going to pay that $1? So does your mum accept £1.50 as a dividend rather than £2.50? I think that's what most people probably think a corporate income tax does. So that would mean that the tax was entirely incident on the shareholders or the owners of the firm. But that may not be who bears the incidence. If the shareholders, depending on how the markets, the labor markets and the consumer markets work, it could be that your mum would try and shift some of that onto you and get you to accept a lower wage, get you to accept a wage of $2. If you had no other job opportunities as a 5-year-old, you might be willing to accept $2, and then your mum would have shifted all of the income tax onto you, and so workers would be made worse off by the income tax. Alternatively, if you were the only lemonade stand in town, you could just charge a higher price. You charge 27 cents instead, and then you've shifted all of the income, all of the tax onto consumers. So exactly which of these people is going to bear the income tax is going to depend on how the relevant markets work. Okay? So if the lemonade market was super competitive, so if your street was filled with little entrepreneurial 5-year-olds who all had lemonade stands, and you were all selling at your marginal cost of 20 cents, then you wouldn't be able to shift any more onto consumers, because if you raised your price, they'd all go to the competitor lemonade stands. So if one of the markets is very competitive, then there would be no opportunity to shift the tax onto that group. In contrast, if you're a monopoly lemonade stand, then you could shift some of the burden onto consumers. Okay? So that's a cute little example that can illustrate the point. We can make that more formal by drawing supply and demand curves, but I'm basically showing you the same thing here. So if we look at the market for lemonades, we can draw a downward sloping red demand curve, meaning, you know, as price increases, people demand less. As price goes down, people demand more. And then we can draw a supply curve that would reflect something to do with your cost structure. And we have an equilibrium at point E, where you charge 25 cents and you sell 50 cups of lemonade. And so now we introduce a tax, so that shifts the supply curve up and to the left, meaning all of your costs have got more expensive. A tax is one way we can typify that by just saying you have to now pay the tax. And so what's going to happen in the way that I've drawn the supply and demand curves here is that consumers are going to pay a bit of the tax. The blue rectangle represents how much consumers are going to pay, and the green rectangle represents how much producers are going to pay. So the tax is going to be incident partly on workers in terms of lower wages and partly on shareholders in terms of lower dividends. And how that's shifted is going to depend on the shape of the demand curves. So I've drawn the demand curves here in a particular way. I could draw a slightly less price-sensitive set of consumers, in which case the consumers will bear more of the burden of the tax. I can draw more price-sensitive consumers, so all I'm really doing is shifting the shape of the demand curve here, and then more of the tax will go on to the producers and less will go to consumers. Okay? And so the idea here is that, the idea to take away here is that, one, corporations are not people. So it's not the case that when we implement a corporate income tax, we're taxing Vodafone or we're taxing Facebook. The people who bear the cost of that are going to be people who are involved with that firm, who may be the shareholders, who may be the workers, or who may be the consumers. And which of them pay the tax is going to depend on the functioning of each of those markets. So in order to understand things to do with the fairness of the way we tax them, we need to understand how those markets work, and so who will ultimately bear the incidence of that tax. So consumers will if the impact of the tax is to increase prices, workers will if the impact is to reduce wages, and shareholders will if the impact of the tax is to reduce dividends or reduce capital gains. So understanding tax incidence is one of the sort of holy grails of public economics. We know pretty little about tax incidence in general, and even less about corporate income tax incidence. So there are estimates out there. In certain circumstances, we know some things about who bears the incidence of corporate income tax. It's pretty clear that it's probably not all borne by shareholders, that some of it is shifted onto workers and some of it is shifted onto consumers. But estimates vary from almost all of it is shifted onto workers, like 80%, to very little of it is shifted onto workers, like 10%. So we don't know the answer to that, and it probably depends on different things to do with the shapes of the demand and supply curves, but we do probably know that it's shared between these groups in some way. And so I think that's a popular misconception about what corporate income taxes do, that people often think of us taxing probably wealthy shareholders when we think of taxing corporate income, but it's not clear that's what we're really doing when we tax corporate income. Okay, so that's the sort of basics of thinking of corporate income tax and how it works. So what I then mainly want to talk about is, so why has there been all this fuss recently? So if you look back 20 years ago, people were talking about how big multinationals paid too much tax because they were taxed in multiple countries and that was unfair and we should be reducing the tax on them. Now suddenly we're talking about how they pay too much tax. So there's a couple of things to say about this. So one is, going back to that picture I showed you in the beginning about how actually as a share of total tax revenue, the amount of money that we get from corporate income taxes has been very stable. that's very remarkable, given that for years people have been predicting, for as long as I've been an economist, this race to the bottom, that there's concerns that we're going to be competing away corporate taxes. Despite that, tax revenues have been pretty buoyant. And that's because corporate taxable profit has increased as a share of GDP, because there's now more activity in the corporate sector as opposed to in the government sector or the firm sector or the personal sector. So there's more incorporated activity. That's partly, for example, of reasons that more women have gone into the labor market, more of what used to be home production is now monetarized and in the market. So there's more cleaning services, and there's more purchasing of pre-prepared foods. So there's some just shift of some things that used to take place at home are now in the market. But there's also other reasons that the size of corporate activity has increased. In addition, profitability of firms has increased. The average profitability of firms in the economy has gone up. But I think really what's at the heart of, and so that, those are the reasons why we haven't, even though tax rates have gone down, we haven't seen a decline in revenue from corporate income. However, I think more importantly for why the concern has arisen about companies like Starbucks and Facebook is because different firms are now potentially paying very different amounts of tax. So there's really quite a lot of variation between the amount of tax, for example, that Starbucks pays and that maybe a company like Nero that's more domestically based pays. And in addition, and I think that goes along with that, the concern has been about where they pay tax. And so in returning to the Starbucks example, I think that's a big part of, it's not so much how much tax Starbucks pays, it's does it pay tax to the UK exchequer or does it pay it to other countries? And as firms have become more multinational, that's become a much bigger issue. And so one of the reasons that that's become a big issue is not only because firms now operate across national borders, but also because firms now rely much more on something called intangible assets rather than tangible assets. Those are like the two worst words to have to say because they sound exactly identical and it's really hard to say them differently. So tangible assets are things like machines and screwdrivers and physical things that you put in a factory floor and you make stuff with. Intangible assets are like ideas, brands, things that do not have a physical, tangible presence, but are very important in creating wealth and value. So in the UK, in the last few years, investments in intangible assets and ideas has overtaken investments in tangible assets. So as an economy, we now invest more in ideas production than we do in machines. So more of what we create is coming out of stuff that's intangible and in our brains than stuff that's physical. And so that causes a bunch of challenges, both to thinking about how we tax companies and where we tax companies, and how value is created. So if we return to the Starbucks example, just to make that a little bit more tangible, why is it that Starbucks didn't pay tax in the UK? Okay, this has been like a massive court case that's generated millions of reams of paper, so clearly I'm not going to tell you all the details of it, and I'm going to grossly oversimplify, but for the point of this lecture, what I'm trying to get across this simplification, I think is okay. So basically, Starbucks makes royalty payments from the UK, so if UK Starbucks, they sell coffee at an exorbitantly high price, which doesn't cost them anything like that, they make a bunch of money. They pay a lot of that money to a Dutch subsidiary, which is the subsidiary that is deemed to own the idea of Starbucks, the Starbucks brand, and the reason that we pay more for Starbucks, right? And that Dutch subsidiary has to pay tax. And the idea is that that Dutch subsidiary bought from the US parent this Starbucks idea, okay? So this typifies the two things I'm trying to talk about. One, the international mobility. It's now much easier for firms to be located in many different countries. Starbucks has its headquarters in Seattle, has this subsidiary in the Netherlands, and then it has a store in the UK. And it can easily, link those different activities. And two, its main asset is this intangible idea that when I sell you a coffee, I ask you your name and write it down and give you a little card that lets you download an app, and I can charge you twice as much for that coffee. That's a very successful business idea, and they're making a lot of money out of it. That wasn't the idea of the manager in the UK. That was the idea of headquarters in Seattle, right? So where does that value arise? If we're trying to tax Starbucks on the profits that they've made from the value created by the people working in that firm, it's not the guy down the street who's operating the coffee machine that had that idea to do that. So there's, to some extent, the firm has a lot of latitude. As I said, I'm grossly oversimplifying, and there's other things that Starbucks done that perhaps are a little bit more tenuous. But, for many firms, there's a kind of conceptually difficult issue to say, where is it that the value is created? Where was this idea created? So perhaps really they should be paying tax in Seattle, not in the UK. So I think the other thing that this example illustrates very well is that the court case, so they've got in trouble for this, and the European Union has taken the Netherlands to court, not Starbucks, they've taken the Netherlands to court, saying you incorrectly charge too low of a tax rate and we don't like you doing that. And they've got in trouble for that, and now people will have to be paying back some of that tax. So there's a role here played by governments as well as by firms, which I'll return to. Okay, so I said most of this. So where did the value arise? It arose, there's a reasonable argument to say that it arose in Seattle, not in the UK. So Facebook is a little bit of a different example, but again, typifies well the role that intangible assets play. So what Facebook did, again, grossly oversimplified to make the point, but Facebook paid all of its profits in the UK to its workers. So one, was that a wrong thing to do? If the workers were the ones who had all the creative ideas that led to Facebook being able to sell ads and make profits, perhaps the workers were the people who should have been paid those profits as opposed to the shareholders. If it was the workers in the firm that created that value, then paying all the profits out to the workers rather than paying the profits to the shareholders would be a completely correct thing to do. So maybe that was a judgment made by the firm. Secondly, is this unfair in terms of tax? Those workers are probably mostly reasonably high income earners working at Facebook, and so they've probably paid tax on that income of 40%, rather than the 20% that the company would have paid had they had them as corporate profits. So in what sense is that unfair? The exchequer is getting possibly more money. Possibly those were the people who created the value. So without knowing more about that, it's not clear prima facie the fact that One Direction, which is a group of 5 guys who make value by singing, and are paying tax on, they're the shareholders of the One Direction company, they're paying tax on the money that they've made. Here, Facebook's taken the decision that the workers are the ones who've generated the value to the company, and so they're the ones paying tax on that. Okay, so to try and put some of that together, what can we say about the current tax system? So if I can try and go back and try and answer my question, is Starbucks paying enough tax, or are corporations in general taxed in the right way? Well, the current tax system that we have was the basis of it was established in 1920s in the League of Nations Agreement. That was based on the principle that countries had the right to tax firms on the activities that took place in those countries. And that was deemed to be the correct way to think about how we taxed the corporate activity. And in the 1920s, that probably made a lot of sense. In the 1920s, most production was physical production in factories, and it made a lot of sense to think of that as a rational way. If a multinational firm produces in multiple countries, then each country gets to tax the value that's created in its country. That's basically still the tax system that we have, with a lot of stuff sticking plaster put on around it. So the basis of the tax system is that individual people pay taxes where they live, and companies pay tax where they create value, it's what's called source-based taxation, the source where they generate the stuff that they make. Okay? And it's this difficulty that as the world has changed and as firms have become more mobile, and more of what firms do is based on these intangible ideas, which are also very mobile. And not only are they mobile, they're also an idea you can apply in many locations at the same time. So it may not even be that meaningful to think about where that idea is generating value, because it may be generating value simultaneously in multiple locations, right? So there's people watching this on TV now. Am I generating negative value for them, watching this in that location, or am I generating it in this location? So as we start having ideas be the source of value and source of production, it becomes much more difficult and makes much less sense to base the principles of the tax system on this idea that each government gets to tax what's created in its jurisdiction. And what most international tax discussion and agreement has been about is trying to put sticking plasters on this kind of old idea of trying to still come up with ways of defining where every bit of income comes from and where it's created, and to maintain this system. And there's a lot of disagreement on how to do that. Disagreement not just between consumers protesting against Starbucks and workers protesting against their wages, but also between governments. So much of the disagreement in this area has been governments fighting with each other. Luxembourg wanting to tax Starbucks very cheaply, while the US wants to tax them more toughly, for example. And so, one of the real problems with this idea of taxing corporate activity where it takes place is that it leads governments to compete with each other. So governments have dual incentives here which are conflicting. On the one hand, they want to raise tax revenue by taxing corporate income and have a fair tax system where they're taxing different types of income. But on the other hand, they want to attract corporate activity in, because corporate activity generates value and wealth and other things. And so aligning those incentives is very difficult. And because of that, it means that it's been very difficult to try and reach international agreement. So while our government, with one mouth, will say, this is unfair tax competition, that that the Netherlands is having this low tax on Starbucks. On the other hand, we're going to have this low tax rate on this other type of income that we want to attract in, right? And so there's been a lot of sort of infighting about that. And there are other ways to think about taxing corporate income. So they involve basically more fundamental reform in thinking more about the underlying principles of the way we try and tax corporate income, rather than trying to just think around the edges about how we change the little minute tax rules. And so just one idea, there's a couple ideas out there that economists have put forward, but one idea I think that's very intuitive to think about and nice to typify how we could move to a different system is that rather than trying to tax corporate income on the basis of where production occurs, as we currently do, we could move to a system where we try and tax corporate profits on the place where sales occur. So rather than trying to tax Starbucks based on apportioning the profits that it makes across different countries, we can just try and tax the coffee directly, the coffee that it sells directly, and try and give some relief potentially for the cost it's borne in creating that coffee, so make it more like a profits tax than a VAT, but something that it's what's more called a destination of sales. So sales is generally much more observable than production. So I said there's other ideas. There's many economists have been working on this. But really what it involves is a more fundamental rethinking of the basis upon which we tax companies, rather than just fiddling around the edges. And I will stop there. So I think we have time for questions. Does anyone want?
So can we just get it straight? We've got two audiences, you folks here and you folks there. Romesh, where's Romesh when you need him? What's the technology for allocating questions across?
Well, I think these people have showed up, so we'll give them the first chance to ask questions.
Can you run around with these mics?
Yep.
So, anyone got a question?
Here we go.
Thank you. Rachel, given that corporations aren't people, why do we try to tax corporate profits at all? Why don't we just tax personal income and capital gains?
Yeah. So that's a great question. So in fact, many economists think that's exactly what we should do. Corporations, you know, it's a sort of withholding tax. It's not really a tax base that we want to tax. One of the big problems is, in fact, we did have an experiment in the UK about 10 years ago or 5 years ago, where we tried to put a zero rate of corporate tax on a certain class of companies, small companies. And overnight, we lost like £1 billion in tax revenue because all the taxi drivers in London became self-employed companies. So an important role that corporate income taxes plays as a backstop to other taxes, in particular labor taxes. If we had no corporate income tax, then we have the corporate form to provide some limited liability to people who are taking risks and being entrepreneurial. And if we allow that to go completely tax-free, then we would have a big shift, potentially a big shift of income into that sector. If we could get around that problem, I think conceptually we would like to not have a corporation tax. A corporation tax is one of the most distortive taxes, and we could tax income in other ways. Here we go, we have a question up here.
Have corporate tax cuts since 2010 lost the government revenue or gained revenue?
Well, that's an incredibly difficult question to answer because we would have to know the counterfactual world in which we hadn't had those corporate tax cuts. And that's something we don't observe. So what we don't know is had we left the corporate income tax rate at 52%, whether the corporate sector would look the same as it does now. Probably it wouldn't. Possibly there wouldn't be such a big corporate sector, though we don't know that. And so it's a bit difficult to answer that question. We can answer that question, of course, if the corporate sector had changed in the way that it changed, we would be collecting more tax revenue. But I don't think that's a very meaningful question because clearly that's such a big tax change that if we had a 52% tax rate and France had a 34% tax rate, we probably wouldn't have nearly so much corporate activity in the UK compared to France. And so the skill of an econometrician, as John put it, is to try and make up those counterfactuals. And we don't know the answer to that particular one. But it's a good question.
Could I ask you to wait until you get the microphone before you ask your question, because we've got the folks on the internet who want to hear the question as well. Thank you.
Hi, first of all, thank you for presenting here. My question is, so you said that the tax profits you should tax profits at the destination of sales. Well, that addresses the question of Starbucks with physical coffee. How about the question of Facebook, which sells not exactly goods, but I'm not even sure what it sells at this point.
Yeah, it sells advertising. That's what it makes its money from. So that's a great question. So I didn't say that this would be the solution to all of our problems. The corporate tax system has a lot of problems and has a lot of, an enormous number of tax lawyers and accountants are employed to figure out how to implement it. So this wouldn't solve every problem. And one particular one is the one you highlight. So what it does is, the argument is that there's more of what's sold is easy to observe than what's produced, right? And so as long as that's true, we're going to get around some of the problem, but we're not going to get around all the problem. And so how you tax any types of services, of intangible, all the same issues would apply to the taxation of intangible things that you buy. And Facebook is a good example. So that doesn't solve that problem. We need a different solution for that.
Given how firms like Starbucks have royalty payments, do you think taxing sort of monetary transactions would be a possible solution to some of the problems?
Right. So, so what that would do would be to change the incentives for them to make different types of monetary payments. So I don't see that you could necessarily solve the problem. I mean, in a way, that's what happens now, is that firms are able to use monetary transactions to reallocate their profits around the globe. So it's not clear to me how you could use those. So one of the problems behind that, in particular, that I didn't mention, when you think about how firms use those payments that they make on royalties, one of the reasons that they're able to do that so well is because if a firm is buying something from itself, like Starbucks UK is buying the Starbucks idea from Seattle, there's no market for that. So the tax authorities have no idea what the price is. In fact, no one really knows what the price is because we don't observe a market for that. So the firm can kind of charge whatever it wants, and it can make that transaction be any value it wants because we have no concept of what that price is. And that's one of the real challenges for tax authorities. It's what's called transfer pricing, that things that are traded within a firm often are not, we don't know what price those should be traded at. And so firms can manipulate that price. So if we introduced a tax, that would lead to manipulation of that price as well as of real activity. So probably.
And just to pick you up on that point, though, isn't that actually the point, that uncannily the transfer pricing charged by Seattle onto Starbucks UK exactly obliterates all the taxable profit of Starbucks UK, hence they pay no tax? What a remarkable coincidence that is. And isn't that the point, that it's so transparently obvious that there is no economic rationale behind the price that is being paid that makes what Starbucks are up to, in essence, and to sound slightly moral about it, so offensive? Isn't that the point? There's clearly no basis for the price that Seattle is charging the UK, other than it eliminates the UK's taxable profit.
Yeah, so just to be clear about one thing, they don't pay no tax. They pay no tax in the UK, but they pay tax in the US. And so then it becomes, they pay tax in the US on the way the US chooses to tax that value. So it's not that they're paying no tax, they're just paying it in the US. So then it becomes, I think, less of a moral question about how much tax they're paying and more of a question about where do you think the value, the fact that I'm willing to pay more for a Starbucks coffee than for a coffee in the coffee shop next door, where does that value arise? So if you think that truly that value arose because of the activities of the workers in Starbucks in the UK, then the transfer price is incorrect. And we should be some of that should be produced in the UK. If you think that that value is entirely arisen because of the good idea that the guys in Seattle had for how to format the store, then they're doing exactly the right thing. And all of the revenue from that is going to Seattle to be taxed there. And frankly, I have no idea which of those is true, but that's the question we need to be able to answer. So I think that's, and I think, what I'm trying to argue is that just doesn't seem, I agree with you to the sense that I think that doesn't seem to make sense as a way of trying to tax modern corporations. And what we're trying to do is to have increasingly complicated rules to apportion all those little bits, when that just isn't really, we should just stop doing that and think about a more sensible system for the modern world where this production is based on ideas. Do you need a microphone? So then we'll come up to you.
Hi, this is a question that's come in online from Gordon West, who's a teacher at Stowe School. If collecting tax is most effective at point of sale, what potential barriers are there restricting governments from adopting this tax collection method?
So there's, I'm not exactly sure they are more effective at point of sale. I think we're arguing that they may provide better incentives. But so one question, I think what that question is asking is, why don't we see this kind of reform take place? And one important reason, is that sales-type taxes are among the politically most unpalatable and unacceptable form of taxes. So they're very transparent to consumers, and consumers tend not to like them. And so it would be a very brave chancellor that would stand up and say, we're getting rid of corporate income taxes and going to increase the rate of some kind of sales tax. And so the way to move between systems, I think there's big issues there. I'm trying to talk about the bigger economic issues rather than those issues, but that is definitely, there are definitely implementation type issues there. We had a question up here too. Someone up, yeah, that boy there.
On the issue of whether Starbucks or big firms are paying too much tax or too little, surely that should come down to how physically conservative a government is or how more socialist it is.
No, I don't think that's right. So I think that how much tax we have in total, that is exactly true. So when I showed you that distributional picture in the beginning, the extent to which the government chooses to tax rich people heavily and redistribute to poor people, or tax, blonde-haired people and redistribute to brown-haired people, or whatever redistribution they want to do, that is definitely about social preferences. Whether or not we raise taxes in the form of corporate income or in other forms is really much more what we'd call an efficiency issue. So the idea is that, we have preferences over the amount of redistribution, but then we should collect those taxes in the most efficient way, causing the least distortion. And so we may well want to tax rich people more. The argument about not taxing Starbucks isn't that we don't want to tax rich people more, it's that it's not a very effective way of taxing rich people, and we may well be able to tax rich people more by creating less distortion and more equally.
That's good.
Yes.
I don't know whether I'm allowed to ask a question as the chair. If you, for the sake of argument, said that all the tax incidents hit the shareholders,
yeah,
then it's obviously not the case that all shareholders are the rich.
No.
A lot of poor people are implicitly or shareholders via their pension funds and things. So what is the relative progressivity or lack of corporate tax compared with, all the other taxes?
So frankly, we don't know the answer to that question. So it rests on two things. So first of all, it rests on incidence. So we can, if corporate taxes are actually incident on workers, then we...
It's a hypothetical...
If it's shareholder, yeah, no, that's right. So people have in the US, and in fact we're just starting a project on this at IFS, in the US people have done this, but what you need to do is basically say, suppose it's 100% incident on shareholders, we can then get some information on the income distribution of shareholders. The additional complication there is that many shareholders are not British. So when I draw that picture, I'm looking at the British population. So if I look at the tax of Starbucks, very few of the shareholders are British. And so then I need to start thinking about how I care about that. So do I, as the British government, who has a set of social preferences, have social preferences over foreign people? And how do I want to incorporate that? So imagine we get around all those complications. We can then say hypothetically it falls on shareholders or 20% on workers, etc. That's what people have done in the US, where it's a bit more of a closed economy. So it's no doubt that shareholders are on the upper part of the income distribution. So like the lowest few deciles have relatively few shares. But it's across the middle and the top of the income distribution.
It seems to me that there's a lot of accountants and consultants being employed trying to estimate what is an acceptable level of royalties to lower the amount of tax. Now, my question is, shouldn't a sensible tax system seek to move intelligent individuals like accountants and consultants away from these rent-seeking activities and into other jobs that add more real value to society? And along with that, what change could we make to corporate tax to bring that about?
Well, I couldn't possibly say that as an economist, but so the, another answer to a question I got somewhere was about why don't we see this kind of reform, is there's a lot of vested interests, not only governments. So something like a destination-based sales tax would have much less reason. I mean, you would still have some professionals determining some aspects of that, but would require much less work and effort in the accounting fineries of where particular activities took place. So it could well have the added benefit that, that those people were no longer employed in those jobs. Whether you could do something in the corporate tax system to ensure that they went into jobs that had high social value, I'm not sure. That would be a challenge too much, I think. But,
Do you support or oppose the idea of reducing welfare by reducing corporation tax and raising the minimum wage so that firms benefit from the reduced tax and yet they pay the poorer workers more?
So I personally wouldn't express a view on that particular. So I think my role both as running the Institute for Fiscal Studies and as a personal economist, I think what economists can do very well is tell you what some of the consequences of such a reform are. I think it's then up to the social preferences of society to decide the amount of redistribution they want, etc. So I personally haven't looked at what the implications of introducing higher minimum wages are, so I don't know. I mean, there are interesting questions around who minimum wage is incident on. So if you increase minimum wages, the same issues arise. Who pays for those in the end? Do they go to consumers in the form of higher prices, or does that take away from corporate profits? We don't know so much about the answer to that. You wouldn't necessarily have to marry those two things up either. Do you have a question?
Right, might sound a bit pickety-ish, but what's to stop a global flat rate of corporation tax? Who would be opposed to it? Who would be for it? And do you think it would sort of eliminate all these problems?
So it depends a lot on what you mean by a flat rate of corporation tax. So something like so one of the potential criticisms of something moving to more like a consumption tax is that it may be, so there's reasons beyond just thinking about corporate income tax to think about the properties of consumption taxes as being better than income taxes, because consumption taxes are a better way of taxing people's lifetime income. So what we'd ideally like to do is to tax people as a proportion of their lifetime income. So what I showed you before was how we tax people as a proportion of their current income. And so, for example, students, when they're at university, have a very low income, but they probably have a very high lifetime income. And we care more about how we tax people based on their lifetime income than their current income. And consumption tends to be a better measure of people's lifetime income than income itself does. And so so this does relate to the flat tax, believe me, I'll get back to that. So one of the reasons that people worry about moving just to a full consumption tax, which in a way what this proposal does is move us partway in that direction, is say let's not tax corporates based on their income, let's tax it where consumption occurs. One of the reasons some people don't like that is because we have nonlinear income taxes. So that means that richer people pay a higher tax rate. So the more income you earn, the higher of a percentage you pay of the income that you've earned. So that's like nonlinear. And so that leads to more redistribution. It's really hard to do that in consumption because when you go and you buy a hamburger, we don't know how many other hamburgers you've eaten. And it's very hard to make the tax rate of the 10th hamburger you eat vary from the 50th hamburger you eat. And so that means that it's a little bit harder to get that type of tax system to be more progressive. And so this type of tax is actually more like a flat rate, would be more like a flat rate kind of tax. And it's harder to make that tax more nonlinear and more progressive in that way. So I think the question was who's in favor of it and who's not in favor of it. I don't really know the answer to that, to be honest, but I know that there are many US economists who are advocating that type of system because it's a much simpler one and are willing to sort of forego the additional redistributive properties that more income tax-based systems have.
Starbucks is known for being a bit of a rip-off. So what argument really do consumers have for wanting to force the tax rise and then making the coffee market less competitive?
Well, you said quite a lot of things there. So I'm not sure that there's much evidence that the coffee market is not competitive. I'm not aware of there being competition investigations on that, but it seems to me like entry is pretty easy given what we've observed, and there's quite a lot of competition in the coffee market. So the question is, why are people willing to pay more for a Starbucks coffee than a different coffee? And I guess the kind of economic answer to that is that they must be getting something like in the form of service, or they must perceive the Starbucks experience as a higher quality experience, and so be willing to pay for that. And that's the outcome of a competitive market where firms are offering different possibilities. So then I think the second part of that question was, you know, if we tax them more, does that going to make their prices go up and put them at a competitive disadvantage? I think what people are worrying about is exactly the opposite of that. Though to be honest, we don't really have great information on the total amount of tax Starbucks pays. But it's not clear whether Starbucks pays less or more tax in aggregate than other coffee companies. We'd need to look at that. So how that fed through into its prices, I don't know what effect that would have.
Is there a question here about free riders, in that company shareholders generate profits because companies use public goods provided by the governments where they exist? And if those companies then use transfer pricing, for example, to avoid those taxes, it's then not possible to provide the public goods that the companies then rely upon to generate their profits.
Yeah, no, so that's a great question and a difficult one to answer. So you know, we spend a lot of time in the kind of traditional analysis of thinking of the way we tax companies is that we want to tax, we call economic rents. So we want to ensure that we tax the profits that companies are earning because they're exploiting things that are produced because of the location in which they operate. So for example, we have a North Sea oil tax. So North Sea oil is something that is very immobile. It earns a lot of profits, in part because of resources that we think we own, not the firms, and so we can tax away a lot of that. So that's right. We would ideally like to tax a bunch of those things. I think the question then becomes, the current tax system tries to do that, and it's pretty expensive, and it doesn't do a great job of doing it, and introduces a lot of distortions. So how far do we want to persist in trying to do that versus accept that that's just going to be really difficult to do, and we might want to go for something simpler that also doesn't achieve everything that we want, but is less distortionary and problematic. So, you know, other alternatives that people put forward, like Mike Devereaux at Oxford, who's done some of the best work on this, it talks about, let's just forget about taxing profits, let's just tax turnover. Turnover is very easy to measure. It doesn't have all the nice properties that we'd ideally like a tax system to have, and it doesn't relieve some of the investment costs that firms have, but it's way easier and maybe less distortionary because we don't have to worry so much about all this stuff, right? So I think the point you're raising is absolutely right, and we would ideally like to do it. The point is, can we do it? And if it's turned out to be so complicated and expensive to do it, is that like got to be our only motivation and our only thing that we need to try and do?
Rachel, I've got a question from a student called Farhan Iqbal who says, as you previously stated, collecting tax at the point of sale is a method that would be effective for a corporation such as Starbucks. What other alternative methods of collecting tax would you suggest that could work for other large corporations such as Facebook? So I guess he's pointing out the fact that it's not quite clear what Facebook sells.
No, exactly. So you know, related to the question we had before, how you tax, you know, so where does Facebook get its income? It's from advertising revenue. So yeah, so taxing companies that taxing anything that has no clear location and physical presence is going to be challenging regardless. And so I think thinking about how you tax Facebook in the right way is just very difficult, and I don't have the answer to that. I think that you know, in fact, Facebook paying all of its profits to its employees makes it incredibly convenient for us to be able to tax them. You know, I don't know. There's a question up there that I can't see.
How would Britain's position in or out of the EU affect the payment of corporation tax?
How would outside of the EU, if we left the, sorry?
Yeah.
If I see. Yeah, so that's a great question. I have no idea. But so we've done a lot of work on how did it joining the EU affect corporation tax. And so I think our best understanding of it is that, you know, firms want to operate in places for all sorts of reasons. Tax is not the only reason at all. Tax is probably, you know, just one of other reasons. So Britain's very attractive. It has a large financial market. It has well-developed consumer markets. It has smart people that are well-trained. So there's all sorts of reasons companies want to come here. So what does joining the EU do to change that? So one way to think about it is that joining the EU reduces other kind of frictions and costs to operating across countries. So it may actually make tax more important because now if I want to serve the British market, it's easier for me to do it from France because we have some common agreements, because being in the EU means you have some common trading agreements, some standards. And so that actually probably makes tax more important because other things are more similar, so less important. So ironically, many people thought that it would make tax competition less, but in fact, I think it probably has made it more because the EU has completely failed to reach any kind of agreements on corporate tax. Despite many years ago being able to reach agreements on a common treatment of VAT-type taxes, corporate taxes proved completely impossible to reach agreements on. So, ironically, leaving the EU may make corporate tax less important if things were reversible in that way.
Just coming to a point you made earlier about the experiment with the small business tax, corporation tax rate of 0%. You said this led to a fall of £1 billion in tax revenues. My question is has there been any research into that stimulating economic activity elsewhere and creating tax revenues through such ways as indirect taxes, for instance?
Yeah, it wasn't allowed to persist long enough because it was very unexpected. And so the Inland Revenue just freaked out and stopped that instantly. No one had guessed that would lead to that big of a tax loss, and it happened very quickly. And so they just immediately reversed it. So if you look at corporate creation rates, there's this funny spike in that year, and you see that. Whether that had any knock-on effect on other types of activities, I'm not aware of whether people have looked at that. It'd be interesting. It may have been too short of a shock. And, you know, the question was, it probably was mainly, didn't change activity. It was a taxi driver that used to be not a company, now became a company, but did exactly the same thing. And I think people think that that's most of what the increase was. So it wasn't really any change in corporate activity. It was just a relabeling of some things that used to be called more like labor income into corporate income. But it would be a great thing to study. I'm not aware of people who've studied it, but I don't know. You got any other? I can't see. No. Oh, upstairs. I can't see upstairs.
Could you shout?
I can't see. Yep, go for it.
I was wondering about perfect knowledge within kind of markets in terms of when the public know about firms paying taxes and having a forum for that, whether that will have an impact on firms, you know, using supply and demand in terms of perfect knowledge of tax payments, whether there's some easy forum would make it so that companies would be more willing to pay tax. Should there be an easy forum for us to go onto and see, oh, Whitbread's is paying that, so let's go to Costa instead of Starbucks?
So I guess there's two parts to that argument. So one, if there was very transparent information about who was paying how much tax, would that change people's perception about what the issues are? And then two, would it change corporate's behavior because that was public knowledge. You know, it's pretty difficult. I was asked this question earlier in a radio interview. So surely naming and shaming has been a very effective way of collecting tax from some companies. Shouldn't we just name and shame more? And it strikes me that's a particularly unfair way of collecting corporate tax revenue. It's going to be the companies that, you know, sell certain types of goods that are in the public imagination that will be, you know, liable to that. And it's pretty difficult. So I study corporate tax, and I know more than the average person about corporate tax. And there's some corporate tax cases that I just have no idea what's going on when I look at the details of it. These are incredibly complex organizations. And so, I mean, I'm all for making everything publicly available, but could you do that in a way that led to people really having coherent, you know, a good perception of how much tax people are paying? I'm not sure. I mean, I think it would be a great idea to try and provide more clear information. I don't think the forums we currently have do that very well, but, you know, maybe we could think of ways of doing that. You got, yep, Ramesh.
Rachel, I've got a couple of questions on VAT from Richard Murphy, who's been tweeting enthusiastically during the lecture. He says, VAT has the highest fraud rate of any UK tax, according to the Treasury. So why add more expectation onto it? And he adds, to get a VAT rate high enough to recover corporate tax as well would have to exceed 26%, maybe rather more. How distortionary is that?
Right, so just to be totally clear, I'm not advocating that we shift everything onto VAT. When I say, I should say VAT-like, so what that means is we would still try and tax corporate profits. So the difference between VAT and profits is something to do with some kinds of costs, like labor costs. But we would try and do that based on the point of sale rather than the point of the profits are generated. So we could imagine trying to tax almost exactly the same tax base, corporate profits, but with the Starbucks example, where let's just make it completely simple. Let's say all of the value of Starbucks is created at headquarters in Seattle. So rather than saying we're going to have all these rules about transfer pricing and payments so that all of the profits go back to Seattle and we tax it in Seattle, we just say, you know what? We tax that amount of money, the amount of profits that they make, but we tax it where the coffee's sold. And that's a more fair tax system. And so it could be, you know, there's no difference in that. We're collecting the same amount of tax. We're levying the same amount of tax on the company. We're just doing it at the point of sale rather than the point of production.
Any more juicy questions?
Hi, can I ask a question about retained earnings and whether there's an incidence of tax on retained earnings?
So
not on the shareholders, but on retained earnings.
Well, so in everything I've been talking about, I'm not distinguishing between whether profits are held within the firm or paid out to shareholders. So just so everyone understands what we mean by this, so when a company earns profits, the company can do two different things. Well, it can do lots of things with it. One thing it can do is keep the money in its pocket and wait for a good opportunity to come along for it to invest in. Alternatively, it could just invest it straight away, or it could pay it out to its shareholders. So retained earnings is the stuff it keeps in its pocket. So currently, we try and tax that. We tax retained earnings. So that's what I've been talking about, basically.
That's right.
So
they seem to be incredibly high at the moment.
yeah, so there's a big controversy. Yeah, exactly. So this is a totally different question to tax. So there is a current puzzle in the US and the UK about why a lot of companies are keeping a lot of cash in their pockets. So some people like Paul Krugman, who writes regularly for the New York Times, says that this is an indication that big corporations have more market power now, are earning higher rents, and are just keeping that money in their pockets. Another line of argument says, or another idea says that the last recession, on the back of some other big world political events, increased uncertainty in the world a lot. The world is now a much less certain place than it used to be. And what happens when uncertainty increases, when firms are less certain about what's going to happen in the future, is that people tend to be a bit firms tend to be conservative and hold money back because they're not sure whether the payoff to this particular investment is it's less certain what it's going to be, and that means that you reduce your investment incentives. So we don't know which of those it is. It's a great question. Many great economists, including working at the Bank of England, are trying to figure that out. We don't know. I don't think tax plays a big role in that, to be perfectly honest. I think that's an important question, but probably not really one about tax. Ramesh has a...
Do you think a regional corporation tax in the UK could help solve the north-south divide?
Wow, so that's a big question. So I guess there's a couple of pieces to that question. So one is, is the disparity in income levels between the north and south due to differences in investment, which is basically in jobs, which is what firms would bring. And then I guess if we want to try and if we thought that that was the case and we wanted to try and address that, we might think about whether there were effective policies that could move some of production away from some areas to other areas, to more impoverished areas. So that's in general, that's actually a very localized version of the bigger picture that I've been talking about, which is, why is a corporate tax distortionary? Or in what you're saying, if we believe that the northeast of England is impoverished because there's not enough investment there, if we provide subsidies for firms to go there, what effects would that have? So the trade-off that you need to think about is that firms are deciding not to invest there when we don't give them incentives. And so assuming that firms have complete information and are making profit-maximizing decisions, then that means that it's more expensive for them to operate there, and there's other reasons why they don't want to be operating there. And so in order to understand the effects of incentivizing them to go there, we need to understand more about what it is, why that's true and what it is we're trying to counter. And so would incentives to invest be the thing that would counter that? Or are there, if the problem is that there's not enough skilled workers, then in those locations, I'm not saying that's true, but imagine it was, then if we provide incentives for firms to invest there, there's still not going to be skilled workers, and so that's not going to lead to increased growth. So without understanding, as economists, what we say, what the market failure is, if there are job opportunities there, if there are investment opportunities there, why aren't firms investing there? In order to have effective policy to address that, we want to understand what failures are leading to the market not providing that, and then target those failures. And so how effective investment incentives would depend on to the extent to which that's the way that the market is failing, or if it's failing for other reasons, then we would more want to target those failures.
Rachel, I've got another question from the interweb. Linda Arch, who's a postgraduate research student at the University of Reading, has a good sort of post-capitalism, future of capitalism question. While maximizing shareholder wealth is the dominant corporate ideology, won't we always have the problem of tax avoidance?
So, again, there's lots of pieces to that question. So, tax, tax avoidance, let's just be clear about what we're talking about. So there's something called tax evasion. Tax evasion is doing something illegal. There's then a word tax avoidance, which one could put in a different terminology, which would be tax minimization. So we generally think that it's a good thing that corporations try to minimize their cost, because that leads to more efficient production and we all get to buy stuff more cheaply, and it leads to an efficient allocation of resources around the economy. So to think that corporations are doing something wrong because they're trying to minimize their costs is, isn't in line with kind of standard neoclassical economics. So if you want to go outside of that and think about people working within companies as having different incentive structures to that, then that might lead you to some other other concerns. But I think within the kind of paradigm of standard economics, what we think about companies doing is minimizing costs, and that is being, leading to an efficient allocation of resources in the world. And so the fact that firms move around to try and minimize the taxes that they pay is hardly surprising. They're trying to do that in the way that they would minimize any other costs. I guess we might want to think about whether governments want to be introducing these types of incentives that lead them in their ability to do that. And it's as much the government's fault that they're able to do that as it is the firms. Jonathan?
Can I just ask about simplicity in the tax system? So quite a lot of the time you've talked about how such and such a proposal has some support because it's said to be very simple. I just wondered how we should think about simplicity. Is it the case, do we know how much, do you have any evidence on whether very complicated tax systems, are they much more costly to administer, for example? Is that part of it?
Yes.
Or should we think about simplicity as being a little bit like monetary policy? We like simple monetary policy rules because people can understand it very well, and so it has a sort of stamp of fairness and civic participation in it. I just wondered how we should think about that issue.
Exactly. I think it's exactly the two things you said, that the attractiveness of a simple tax system is, one, it's transparent, so we can all understand it more clearly. The corporate tax system, as I said, I've studied it for years, and there's bits of it that I have no idea how they work. And according to John, I have above average IQ. But I still have no idea. So transparency is an important, and then the efficiency with which we can implement it. The more complicated, as this fellow up here asked before, the operating a corporate tax system employs armies of accountants and lawyers and economists, actually, and that a simpler system wouldn't need all of that cost in implementing it. And so for those reasons, simplicity is a desirable property in a tax system. We've actually had for many years a set of lawyers who worked a bit with the IFS and some other organizations just trying to rewrite the tax code. Our tax code was started a long time ago and written in rather arcane language. And they're just trying to rewrite it so that it's written in more plain English and in fewer words. That's proving very difficult. I think they've shortened some things. But that's seen as a value in itself because it means it's more open to more people to utilize and engage with and understand. I think
Rachel, that was beautifully clear, very compelling, very charismatic. And unless we've got any questions from someone called MacDonald or Osborne or Cameron? Corbyn? No? Okay. I think we should draw it to a close and say thank you to Rachel. Could I say that, isn't it obvious that Rachel is a wonderful role model? And if you think that you would like to see yourself where she is at the stage that she is at, then please come and share tea and biscuits. I'm not sure about the food, but anyway, there'll be some drinks in a room that away. And everybody here is invited. Unfortunately, the people on the interweb are not invited. But I understand, I think I understand that Rachel's career from school through to where she is today and the exalted position she now occupies was a checkered one and an interesting one. And you might like to come and quiz her about that. So again, could we clap her for a wonderful afternoon?
We'll go through to the other room, it's behind us.